Good morning, good day, everyone. Welcome back to the Crypto and Coffee podcast. I'm your host, Giordano Burstmars, joined along by David Blackstone and Cordell Tani. And today we have a very insightful topic for, the founders or co-founders out there, right? So we're going to be basically talking about how to build a startup without venture capital. I know on previous episodes, we talked about how to build in the bear and bull market, how to find great co-founders, what it really takes to, get into like, the startup, a startup venture or be an entrepreneur, right? So right now we're going to be talking about what it takes to really build a startup without venture capital, or basically our lessons on a whole, right? So I think just to start off everything, most people need to understand that without venture capital, you need to bootstrap your startup going in, right? And depending on what your startup is and what your initial overhead costs, your bootstrap may vary. Cordo?
Definitely. Yeah. All right. Well, I mean, the first thing I'll say is, like the decision whether or not to go, venture capital or to bootstrap is going to depend on a number of different things, right? Going venture capital. I think the problem is that we've all been led to believe that you have to go venture capital, right? We're
True.
constantly reading about, oh, look who was raised Series A, Series B, and then you see all the congratulations. Oh, we've just raised $20 million. So everyone sort of feels the pressure that this is the only way to go. But just like everything in life, there's pros and cons to everything, right? And you have to carefully weigh the decision, you know, should you go the VC route? Just, from a high level, just understand going the VC route means giving up a significant portion of control of the company, having to, you know, do what other people want. They're going to want to put people on the board. It's like you're giving up more than just, percent ownership of the company. You're giving up a little bit in terms of lifestyle and control. So it's like, and real control, like, it's very, oh yeah, I'm just giving up 30-40% of the company. No, it's not like that. In many ways, you're giving up more than just share ownership. So people need to understand that. The advantages, of course, is you get fed money and people with experience. So it's like really trying to find the equilibrium between all of it is the tough part.
Yeah. And what most people don't even realize is that it's more or less about like leverage, like how much leverage do you have going into this deal. But on the other side of the spectrum, once you really get funding from one venture capital, it's more or less like, you get funding in a pool from the rest.
Yeah. Well, that's pretty much, yeah, that's exactly what it is. And the other thing I'd point out is, especially from the bootstrap or even just getting a first raise from friends and family, which was the first thing that I did. So when I started my first company, Trend Profits, in 2022, we just raised from friends and family. And, the way I structured it was that, it's a Canadian corporation, but the friends and family were granted share ownership out of Class B shares. They were non-voting shares. So, we gave up, I think it was like 12% of the company, three people, three friends and family contributed. We gave them 4% each, but of Class B shares, meaning they were non-voting shares. So the three founders still had essentially full control of the company. So how you structure it in terms of your share ownership is really, really important too. So, and then at least that gave us something to work with, something to start with. And if you think about it, right, and this is the question that I would say, like when you raise money, your first raise, your first two raises, what do you think that money is needed for? And like just answer that question right away. What are you raising the money for? If the money is simply to pay your own salary, forget it. Okay. Like that's just not going to work. I get it. Everybody needs to eat, everybody needs to live. But if you're simply raising money where the majority of it is going to pay the founders, forget it. That's a recipe for disaster right away. You need the money mostly for marketing, sales, and to hire people for key roles. That's what your initial spends are going to be on: marketing, product development, getting key people.
Yeah, completely true, completely true. And if you're not really furthering the I don't think it's necessarily wrong to like pay yourself something based on the round itself, but really and
I
truly,
agree.
yeah, it's more or less just bettering the business on a whole. But if you look at, let's say, the timeline for like funding, right? We're starting from friends and family to probably Series C, right? I think the only time you really should be looking at salaries is probably in like maybe Series A, possibly.
I agree. I think, friends and family, you shouldn't be taking a dime for salary. It's really to get the MVP going. It's really just
Yeah,
to get an initial foothold, initial anything to start generating some revenue or get into a position to start generating revenue. So, I mean, we didn't take a penny salary from it. I mean, we didn't raise nearly enough to be able to take a penny salary from it. It was meant for marketing and just
yeah,
to start to take the company to a point where it's, a functional company.
yeah. And I wanted to ask, just a little bit more about like, your previous company and the friends and family around Cordell. How much people did you reach out to? Just to give like a little reality check to some people.
Not that many, but I'm fortunate that I had a number of people, like close family members, that were willing to support me. Not everyone's going to be in that position.
Sure, sure.
So, I mean, I think David probably had more experience on that side than I did because I was lucky. The last thing I actually ever wanted to do was to involve my family or
Mm,
friends
yeah,
because it affects your judgment. It affects the way you do things. I'll be very honest about that. Taking money from friends and family, even though, look, quite honestly, if you're going to support a startup, you should really expect every single penny of your money to be gone.
yeah,
What's the
true.
success rate of a startup? What's the success rate?
It's
10% at best?
it's probably about like, yeah, around that. Like I think like 1% of startups actually do become unicorns. Probably like 10% make it, if I'm not
Okay, let's
mistaken.
not even say unicorn, making it to the point where investors get their money back. Let's even like frame it like that. 10, I don't even know, like 10%?
True. I think it's around 10%, between like 5 and 10%. Correct me if I'm wrong, David.
I don't know that number off the top of my head, but going by nature, what the distribution that tends to work, which is also what the IRS checks for if there's fraud going on your report. I don't remember what the name of that distribution is, but it starts off high, drops rapidly, and then levels off towards the end. That one would say it would be roughly around 1% that would be successful, because around 1% that tends to get all of the rewards.
Yeah. I think that kind of does check out. And then it's more or less like, venture capitals are very, let's see, for lack of a better term, stingy with where they put their capital in, right? And they're mostly looking like, 5 to 10 years ahead as to what they start maybe or maybe doing.
Yeah. Yeah. So let's say that sounds right. So let's just say we'll all agree it's an incredibly low number. Okay. Let's just agree on that. It's a
Yeah,
low number. So if you're going to be funding, you're pretty much should have the expectation that you're going to lose every penny of it.
yeah,
So, in even understanding that the people that you're raising from might know this, that doesn't make it any easier on you.
yeah,
So, it's look, and I look, it's also just who I am. I care. It's the responsibility of everything like that. So it affects the way you make decisions in a bad way
yeah,
because it's a conflict of interest. In my opinion, it's a complete conflict of interest.
yeah.
And my advice out there is if you're going to raise from friends and family, like, you have to make sure that whatever you're doing is in the best interest of the company and not necessarily the best interest of your family,
That's true.
right? I mean, in an ideal world, they'll be the same, but it's not always going to be that way.
Yeah,
What I mean, here's another way of looking at it. I mean, let's say you do this and you're working with other people, and part of the problem, and it's not just from my experience, I've seen this from so many, is that not everybody contributes to the raise. And then you can start having this kind of like tug of war that, well, I'm the one who raised the money, not you. And then it can create that kind of conflict and resentment, even to a certain degree. And then let's say it's not working. How do you walk away?
mm,
How do you walk away when it's not just about you? You've put your friends and family in the line of fire now. So every decision you make, what's best for you might not always be best for the people
true.
you've raised from. So it's
Yeah,
just something that I learned really on is just that you're going to have to deal with these conflicts of interest when you're doing your first angel, and depending who you're raising from, and you've got to be very, very good at developing like steel underwear kind of thing, all right? Just like insulating yourself from emotion and just it's not an easy thing to do. It's not for everyone. So it's just one piece of advice, be careful who you're raised from, because it's going to affect your decision-making process.
That is true.
Yeah.
That is true. That is true. But I do find that, if you're really going to invest in a company, it's kind of somewhat like gambling. You really shouldn't put money in that you don't plan on losing, or you don't really necessarily care too much about.
Of course. I mean, like if you look at the average venture capital fund, they know that 1 out of every 20 of their investments is going to succeed. The other 19 are going to fail. And you're just banking on that one to carry everything, because the returns are going to be astronomical. But I am still kind of curious, because I remember we had this conversation a long time ago, the three of us. So like David, I because Gio's question was like, how many people did you realistically approach? Did you approach people for friends and family, like for an angel?
No.
For like an initial? No?
And there's a reason why. Like basically throughout every period where I've been asking people about anything related to money, I found out that basically no one around me has any. So either people don't have money or don't have time. And with regards to my own upbringing, I was born to teachers, so that gives you an idea. And then with everyone that came about, most people. I'm a millennial, so most people, when I entered the job force, weren't able to get jobs. I was, so lucky on that, but most people weren't. I went up a little bit further, did well in investing. Most people didn't. So with various drops, a lot of them lost money. I didn't. With regards to getting a good job and having free time and availability to look into those things and all that stuff, I did very well. A lot of people didn't. So when it came around time to start these businesses, I didn't ask anyone, because I knew that most of them, like as you see in the news, this is something that spoke to me. So it felt true to me when it was reported that most Americans don't even have like 3-digit numbers within their bank accounts. That seems to reflect within the people that I know. Now, I've not seen their bank accounts specifically, but I know that they can't just take a trip around Latin America like when I want to go.
Yeah.
So I'm pretty sure that they don't have the free capital for that. I'm pretty sure that most of them are living paycheck to paycheck, and I can't ask them for money in those cases.
I do want to say, though, I mean, look, I didn't raise that much. It's not like we're talking about like I raised $1 million. That wasn't needed. I mean, yes, that would have helped pay for salaries, but look, it was just enough to pay for the initial marketing. Eventually, what I was doing with Trend Profits, the first company, would have eventually morphed into exactly what I'm doing now. It all just, they were all just different business lines that eventually one or two of the business lines turned out to be the most profitable, or the ones that I should be, like the consulting side and just, building trading strategies for people. That was just the angles of it that really, really worked out. And quite frankly, I don't think I really needed to raise money for that at all, because, most of it is just eventually taking advantage of my network, and then I guess this actually would probably come into another part of our conversation here when you're bootstrapping is, the importance of social media and all these things. I mean, look, obviously it depends on the nature of your business, right? It clearly depends on the nature of your business. Not every business is the same. But, most people have this illusion that they're just going to walk onto social media, make some posts, do some advertising, and everybody's going to come. And that's not it at all, right? So when we think about, assuming like, that we're all using the web, let's call it, or whatever we want to call it for marketing, for exposure, the typical way that people have been marketing a web-based company or something like that is, the sales funnel. The typical sales funnel is, right, you offer a freebie. So you come get our 20-page ebook telling you how to bootstrap a company, for example. So then you have to go to a website, you put in your email address, and then you're going to start getting marketed to. People are going to start marketing their first level product through the email. And then hopefully people start buying from there, and then you can sell them the next level up. That's the sales funnel. And I forget the name of the book. It was .com. I forget the name of the book, but everybody knows this book and everybody knows the author that pretty much outlines this entire sales funnel. So the whole purpose of social media in that respect is not really to sell. It's just to generate traffic to your website to get the email address so then you can market. So that's typically for a web-based business. This has been the playbook. So, you don't really need a lot of money for that. honestly. You don't. If you're going to start paying for social media advertising, this is where things can get crazy expensive. And, doing your keyword searches and doing everything like that, and SEO and all of this stuff, like, you really need to know what you're doing. There is absolutely value in hiring a good digital marketing company for that, but understanding it's going to be expensive. And the whole point is to somehow funnel people, to get people into your sales funnel. So that's if you're doing the online business. When we're starting to deal with crypto, and then it gets entirely different, right? The entire bootstrapping playbook is going to be very different once we're getting into the cryptocurrency Web3 world. So this was just a simple example of, a web-based business of the traditional playbook, where people think they're just going to get online, sell a product, and it's all going to be easy. And that is not true at all.
Well, it's not entirely helped by the VCs themselves. Now, those people, the ones who you're trying to avoid getting investment from, as according to this episode, is like, those are the ones that are telling everyone, like, oh yeah, like you come, you pitch to us, like, if you have a great idea, we'll fund it. And they're also the ones on Twitter who are saying, like, along the lines of what you just said. They're also the ones on Twitter who are saying that if you start a business in tech, you'll have basically no costs. You can start a business for pretty much for free. And you see their posts saying that, and they'll tell you that pretty much exactly. They're lying to your face. Everything has a cost. Your server has a cost. The DNS has a cost. Any type of SEO you do is going to have a cost. Any sort of acquisitions into customers, that's going to have a cost, because you have to get eyes out there. If you go onto Twitter and you do marketing through Twitter, that's going to have a cost. Every single thing that you do is going to have a cost on that, and it will add up.
I agree. And people say, I'm just going to do it organically. I'm like, yeah, you can, but I don't know what kind of results you're expecting from doing this all organically. I mean, that could take you 5 to 10 years to get to a point where you have a significant enough following or whatever it is to do these things organically. So I think most people are sold on this illusion of how easy, or, and that it's free. But yes, nowadays with a lot of these AI tools, you can build for cheap. Let's not say for free, but you could build for cheap. You can build an MVP or whatever you want to call it for cheap. What you're going to do after that is not going to be cheap. And David's 100% right. You're always going to be figuring out what's your acquisition cost per customer. You're always going to be wrestling with that.
Yeah. So let me bring back a little bit of a question here, right? I know everyone here has started a startup, like had a job first and bootstrapped the startup from that job, right? So for Cordell and David, I want you guys to basically explain to the audience how you guys transitions from your, let's say, 9 to 5 or your remote job or whatever the case may be, all the way to your startup, right? Just so someone like the regular Joe has an idea of the process it may take, or like the goals or milestones that needs to be set to really transition over fully to the startup.
Okay. So I'll go first. So, I mean, first, look, I have to say, look, guys, I'm a little bit older than you two. I might not look it, but don't forget that I'm 50 years old. Okay. I know I don't look it, but at least I hope I don't look it. I shouldn't say I know. I'm told, but anyway, so, I mean, look, and I've been in a portfolio manager for many, many, many years, and I've worked for some of Canada's largest companies. So I've had I'm not going to say an amazing, I've had a decent career. I also worked for a lot of companies that were just terrible companies that did not last or got taken out. But, I would say that, I mean, by the time I decided to do this, when I was so it was like 2020, 2021, I made the decision to start getting ready to start some kind of consulting company, or build like a, market some of the trading algorithms that I was building. So when it took me like 2 to 3 years when I decided to quit my job, so I knew that eventually it was going to come. I didn't know 100% when, but I started saving up like crazy. So essentially, like, if you do not have 2 years worth of cash built up to fund a minimum lifestyle, don't do it. Like, just don't do it. You need at least 2 years in the bank. At least that was my experience, right? Given family, house, whatever, mortgage, you don't, like, I wasn't going to take that risk without knowing that I would have 2 years of cash, like, in the bank that I can spend every single penny of to live. So, and then that was advice that was given to me years ago, before somebody I know that started their own portfolio management firm, because they said, even if you start your own portfolio management firm coming from another successful hedge fund, it's going to take you time before you're profitable enough to even come close to probably what you were making before. So that was number one. Have about 2 years worth of cash for, your expenses saved up in the bank. So yeah, after that though, I'll just say it like this, once you're doing it, I mean, it was a little bit of a weird change where all of a sudden, I was working 3-4 hours at night coding and doing stuff, where all of a sudden this was my job, like doing it full time. And then all of a sudden you realize you are not really being paid for what you are doing. And that's a little bit of a shock to the system. So it sort of gets you focused in ways that you've never been focused before, knowing that now every minute that you spend, you have to approach like being a lawyer. Every minute that you spend is a billable hour. And what are you doing now that's going to get you closer to generating revenue? And if all of the founders are not focused exactly like that, there's going to be a problem. Like all of your energy has to be devoted to making money. Otherwise, you're on life support. The second you quit your job to start a company, and I know this sounds terribly negative, but it's the truth. And I think I got this from reading a lot of stuff from, I can't believe I just forgot the name, Sam Altman, where the accelerator, the huge, I can't believe I just forgot the name. It was like the most important seeders out there. We'll come back to it. Anyways, one of the things that they said is like the second you're just burning cash. You're burning cash and time. You are essentially dying. Every startup is dying until you get to the point where you're not. And if people don't realize that, that's one of the biggest shocks that you're going to find when you quit your job. And if you're going to have to realize that pretty fast. You're on life support.
Fair enough. David, what about you? Any lessons?
In my case, I didn't start, I didn't quit until I was ready. Well, until I thought I was ready. I wasn't ready, but until I thought I was ready.
You're never ready.
Yeah. With that, I worked for a good bit. I got into a good job, put a good bit towards retirement and savings. Worked first on building up an investment portfolio. So my very first the very first step towards entrepreneurship was researching previous businesses, getting good at investing and investing in those. So I outdid the S&P every year that I was in the market. Literally every year. Down years as well, I was making money. That's typically pretty hard to do. So I was doing that. And I got up to $250,000, then got started with it. Now, even then, while I was paying for all that stuff, I didn't quit a job. So I was still working. I was working at the job 40 hours. Like during the 9 to 5, I was working for them. And then immediately after, I would close out all the windows that had anything to do with that job, and then open all the ones that had to do with building a blockchain. So I was working 9 to 5 for them, and then 5 to 9 on the weekdays for this, and then weekends as well. So I was essentially getting 80-hour weeks or more every week for that. So that went on for a year until it was in a proof of concept state, so that way I could get it over to its investment. Now, here's the part that I would skip for anyone else. With that year afterwards, after I got the proof of concept ready, after I got everything provable that yes, this would work, that next year I spent trying to raise investment. I would skip that year. For everyone else, I would absolutely skip that year because that was a wasted year, absolutely wasted. Instead, I would go immediately trying to sell to customers, trying to grow that, or trying to pivot over to something else should that not work. So that way you could try to make money with that other thing. I would not go to investors at all, but I would instead try to continue building. Once you have money coming in and you have everything proven for that, if you have once you're thinking that, oh yeah, I don't need investors, that's when you can go to investors. Before then, I wouldn't do it. Now. There are other businesses that I've started outside of that, and I did the exact same thing that I did for that one, of working outside of my job for that. So any hour not given to my job was given towards that. So I did that multiple times. Now every single time, here's the unfortunate bit. Every single time there was some big company that came in and started doing either the thing that I was doing or some aspect of it. Usually just a subset of it. But every single time I thought I can't compete with them. Instead of doing that, compete with them anyway. If for example, using an example from my best, if you're looking into visual recognition of items, and you're thinking that you can sell that to grocery stores, and you think that would help make the shopping process easier, since you don't have to go to self-serve, you don't have to wait for 20 minutes as a customer or anything along those lines, and you can save money. You can help the company save money and save time, save revenue by not having to put people up there and having them do other things instead. And you can save money for the customer. Well, you can save time for the customer by not having them stand in line for 10, 20, 30 minutes at a time. Well, great, go for it. Amazon comes out. They say, hey, here's our store. It does all that stuff for you. It's like, okay, well, this AI problem's already been solved, right? I shouldn't do this anymore because I'd have to compete with Amazon, a multi-billion, multi-country company, right? Well, that would make sense, except if I had continued on it because I actually had the technology. A few years later, I would have found out that their AI is actually Indians, and I would have been good. So instead, just continue it anyway. And when I say actually Indians, that's literally the term that came out for the time, because multiple companies that were pitching themselves as AI were literally just hiring out rooms of Indians to do the stuff for them, like look through the cameras and then do whatever. That's literally what Amazon did.
Okay, fair enough. That was a great explanation. And I wanted to ask something, right?
Hang on a sec, Gio.
Yeah, go ahead.
Before you go on, it's Y Combinator. The name I couldn't remember was Y Combinator. And I don't know how anyone that's in an entrepreneurial role can even forget that name. So anyways, I just wanted to say I figured it out. It was Y Combinator.
Yeah, and Y Combinator is like actually the biggest startup whole accelerator. So if you're in like, let's say an entrepreneur, you're in a startup, you have to know about that.
They have amazing resources on their website, good courses, good resources. You know, they even have what's called a safe, right? If you are going to go the VC route, the typical vehicle for raising is called a safe, because you know, you don't want to give up equity on day one. And at the same time, because this is the equity versus debt kind of thing. So everybody that's watched any version of Dragon's Den or Shark Tank or whatever the local version is called knows that you're trying to raise debt, you know, issue debt, a loan, or you're giving up shares. Now, both have pros and cons, but most people don't want to go into debt because that's a noose around your neck. That is like, okay, now I have to give somebody money no matter what at the end of every month, let's say, or I give up shares and then I'm giving up ownership. So the problem with like debt, as I told you, you're putting a noose around your neck. It's like, you know, so what the safe is, it's a convertible bond essentially that you're giving up. And this has been the most popular way to raise money for your VC, if you're going the VC route, is the safe, because the safe is essentially a convertible bond. It's an interest-free loan, so you don't have that noose around your neck, but the interest does accrue, so to speak. And then when you hit certain milestones, it gets converted to equity. So you're not giving up the equity right away. So this has been the most popular thing. And if you go to Y Combinator, they've had like, you know, sample safes and terms like that. Like the amount of resources that I got on Y Combinator at first, this was pretty much, I was spending so much time just for my own personal education and doing their courses on, you know, not just building a business plan, stuff like that. But, you know, and that's another thing that I would want to bring up, is everyone says, oh, make a business plan, make a business plan. You don't need a full out business plan. All right. So ultimately, you know, a business plan could be a 40, 50-page document. All right. Sure. If you're alone in your basement, you do not need a 50-page document. I'm telling you, no one's going to read it, even if you do. Ultimately, you're supposed to come up with, and this is what I was told, and I learned this from Y Combinator, first get your value proposition, right? So, you know, the textbook, what problem are you solving? Okay. Like solve a problem. And that's the value proposition. So the whole value proposition is supposed to be, what are the pain points? What are people doing today to try and solve those pain points? How is this, all the thing like that. So once you have your value proposition, you build the business canvas. So the business canvas is essentially a one-page business plan where you're outlining the value proposition, and then every other element that's going to go into the business. Marketing, like how are you going to reach your target customers? What is the revenue plan? What's the cost model? And then, what are the partners that you would need? What is the infrastructure? You just pretty much outline all of it in a one pager, and it gives you that roadmap. This is something I got from Y Combinator, and I found tremendously useful. So, and I got that from a number of accelerators that I was speaking to gave me the suggestion on going with the business canvas route. And that is really the first step, I think, for anyone that has the idea, is build your value proposition canvas and then build the business canvas, which is essentially outlining the key elements that will be required to make this business work. So that's something I got from Y Combinator that I thought was incredibly useful for me.
Yeah. And I think like one thing that you probably left out, Corda, that everyone here probably knows already, is that you can probably, let's say, make whatever business plan, pitch deck, whatever the case may be. But I think the speed or execution of what you're doing is more important than anything. Just getting something out there and then adjusting.
Oh, absolutely. Absolutely. So, it all comes back down to your product, the minimum viable product. And I think most people, because I certainly misunderstood what an MVP is. In the VC world, an MVP is essentially just a proof of concept. It's just really the proof that this thing can work and make money. But if you're bootstrapping, that is not your MVP. Your MVP actually has to be a product that you could generate at least a little bit of revenue to get things going. So there's a huge difference in what your MVP is in terms of being a bootstrap or being on the VC route. So if you're going to be doing this, you're bootstrapping, your minimum viable product has to be profitable. And just solving a generic problem is likely not going to generate any revenue at all. If you're going to go this route, you really have to solve some kind of massive, someone's house on fire kind of problem that they're willing to pay for a little minimum buggy software than the full out working product. But yeah, I 100% agree. Getting it out there and getting something done is the most important thing. It will never be perfect.
Yeah.
You're going to spend the rest of your life perfecting what you're working on. And if you're going to wait for it to be perfect, you'll never get it out and someone's going to beat you to it.
Yeah, completely agree. And that also actually goes into another question I wanted to ask both of you guys, right? For VCs, it's very easy to write a check or whatever check to Series A and up, right? But what do you think VCs look for in pre-seed all the way down to angel round? What really separates the startup? Because as David said previously in the podcast, this episode, the VCs will fund, let's say, 20 startups and only one will really make it. What do VCs really look for?
Okay, you want to go first?
Oh, no one's gonna like my answer, but I'd say pedigree.
You say what? Sorry.
Pedigree. How you have you have the show dogs who come from these long lines of dogs that have been bred for this specific thing, and they're show dogs. They go for millions or hundreds of thousands or millions, whatever the price is. I don't know the price. I've never looked into that. But they're if they don't like mutts. They don't like dogs who have been bred with the common dog, like pedigree. So these would be the rich people, the club, the people who talk to each other and avoid you. So the entire thing of rich people go through these different phases, and then the middle class copies that, and then the rich immediately pivot over to something else. Those people, that kind of pedigree. If you've gone to Harvard, if you've gone to Stanford, if you've gone to any other Ivy League, then you're probably you have a bit of pedigree. You have that thing that says, yes, this guy, he is of the upper level. If you've got daddy's connections, then congratulations, you're of the upper level. If you've got daddy's money, you're of the upper level. All of that stuff. If you have a high level of money, that's it. Now you can have a business otherwise, and if you've gotten a business otherwise, if you've gotten it up, if you've gotten it to make money, congratulations. That's another thing that you could do. It's Very, very difficult. It's very unlikely. But if you can get that, which is why I said before, like if you can get the money and if you can get to the point where you feel you don't need an investor, that's the time that you can get an investment. If you get to there, congratulations, you can go through that route and you can get investment that way. But for everyone else, anyone that has something that is not making money, you probably need the pedigree.
I 100% agree. I think I would say it a little bit differently, though. I mean, it definitely helps. Without a doubt, the pedigree definitely makes a huge difference. So I have a friend, a high school friend, that just did a second exit, software engineer. And I remember back even in early 2000, we were going down for, I think it's New Orleans for a friend's bachelor party. And that entire flight back, he kept telling me to shut up because he was on his laptop the whole time coding, building his software. And I was like, man, come on, let's relax a little bit. But no, he was just so dedicated. The guy's an absolute genius. And when I was starting my first company a couple of years ago, and I wanted to ask his advice, we were out for dinner. And what he said, the most important thing for like Angel Series A, like the initial, it's like they're going to look at who you are and what your track record is. Can you do this? They're going to prefer someone that's done it before that can actually execute. So number one is who you are. Number two is what's the total addressable market and how much money am I going to make? It really comes down to it's that simple. That's what he told me. Who you are, total addressable market, how much money are they going to make? That's it. Those are the three things you're most likely going to need to address with your first conversation for raising money. So as Dave was just talking about pedigree, clearly the who you are is part of that, right? But I was explaining that it's much more about your track record and are you the person to do this?
Yeah. If you've gotten the previous, like I used to throw that on the examples too. Like if you've got 5 previous successful exits, I inflated a little bit. But like if you've got a previous successful exit, like you've probably funded. So if like on that very first one, if you did it yourself, if you bootstrapped it yourself and then you were able to exit, like you can use that. Like that's the example. If you don't, then you're going to have to rely on something else, and that something else is going to be what they're going to use to determine whether or not you can do it, and that's probably going to be the connections. Now, you being born teachers, as an example, I don't have connections. I may have the knowledge. I'm not going to have the connections. I'm not going to have the money. I'm not going to have the connections. I'm not going to have the previous successful exits because, like, very literally, like that first hurdle to get over is very, very difficult. So if you can get the business and all that, great. Google, like being an engineer at one of the FANG companies, you don't have to have been born to a rich family to do that, but that is also pedigree. So like there's that as well. Like those things that they're going to look for are that sort of thing. Now with AI, I've not raised post LLM, but with that whole sort of thing, they're probably going to look a little bit less on the engineering side and more so on the business side. Because like when I was looking at what these investors were saying, they're saying that, oh yeah, you can just bootstrap it yourself now. You can just build the proof of concept yourself. You can get to the MVP level using AI. So basically, they're probably not going to be looking at the FANG guys anymore, and they're probably going to be looking more towards business guys, someone who knows the area more, someone who's like gotten to the C level or executive level of a company before, because they're going to look at those guys and say, yeah, those guys know what they're doing, as opposed to you who has an idea and may have been doing the work before. You're going to have to prove yourself.
I agree. I completely agree.
Yeah.
The other kind of things I would probably say, of advice here, when we're starting to deal with, proving yourself or even just getting back to the product, the MVP a little bit, if you're bootstrapping, you're not going to, number one, you can't automate everything on day one, nor should you be trying to automate everything on day one. Everything has a cost. And as we've been trying to say here is that you have to minimize your costs, especially if your revenue is like very, very little. If you have 30 customers or 50 customers, you don't need to automate. It's okay to do things manually until it isn't. And in fact, trying to automate everything on day one is just a waste of time and money right away. So don't be scared of doing things manually at first. The next thing I would say is everybody thinks, oh, you know what? I'll give it away for free now, and then I'll start charging once I get to a critical point. That doesn't work either. Once people get used to getting something for free, they will never pay for it. All right. We are living in a world now where everybody wants everything for free. Not just wants, everybody expects to get almost everything out there for free. You can't afford to start, giving your product away for free on day one and expect to charge later. You have to start charging right away. I get it. You might want to start with some kind of like limited functionality freemium model. Yeah, but that's not the same thing, right? Because you're not giving away your full product for free. You're using that to entice people to pay for the full product. That makes perfect sense. But you can't just start giving things away for free. And the other thing I would say is get feedback immediately. You want to constantly be talking to your customers and understanding their needs and how they feel about your product. So one of the best pieces of advice I was given from a number of different people is that when somebody buys, send them a survey right away. How did you find out about us? What, all these, every little piece of information that you could gather, that's currency. That's your company's currency. So don't be scared to send user surveys. Don't expect good response rates, but sending something like, right after somebody signs up saying, oh, great. Even the simple question, how did you hear about us? Think about what that knowledge will do for you. So don't be scared to do that, to ask for surveys and ask for user feedback. You should be always talking to your end users. And lastly, learn how to do some guerrilla marketing. It's painful. It's a grunt, but that's going to be your only option unless you're going to really start looking into paying for Google ads and things like that. Learn how to do your own guerrilla marketing, learn how to do your own video editing, learn how to do all of that. The more that you learn how to do on your own, to be the jack of all trades is going to help you out there a little bit, at least on saving costs, because you can't pay everybody to do everything for you.
Yeah, completely agree. I completely agree. But we're in the age of AI. So a lot of this automation and, a lot of the subscriptions does make, hiring or doing certain tasks a lot easier.
Oh, it's definitely changed the landscape in the past 2-3 years. I mean, again, I'll say it like now, especially for what I do for my clients and what I need to do in a given day, what used to take me 2 weeks, I now get done in 3 hours.
Yeah.
I said it, my role has changed from having to play every instrument in the orchestra to now I'm the conductor. Yeah. And I am so much better at my job because of that, because I don't have to waste time doing the grunt work or doing the things that, doesn't take necessarily a lot of thinking. It takes the coding skill or whatever. It's more mechanical, it's robotic. But now the fact that I spend most of my time thinking about how to build the project, how to craft the prompt or what's going to go into building it, and then just perfecting that and then just saying go, it's the quality, everything's just improved. So like I said, my role is completely changed because of AI, because now I'm the conductor instead of the performer. And it's made a huge difference in everything that I do.
Yeah.
Like I can't, when I look back to what I've accomplished in the past 4 months of this year alone, I honestly, I'm amazed. I'm also amazed I haven't burnt out. Okay. And that's a huge issue. Don't forget about that, guys. Like burnout is a huge problem. Yeah. I could easily work 12 hours a day if I'm not careful.
That's true. And, before we end off this week's episode, I wanted to ask both of you guys if you can give one piece of advice to, like, let's say any person that is maybe 16 to the age of 25 that wants to start a startup. Doesn't matter what it is. What is one piece of advice, one short line, one sentence that you would give them?
Well, I'd say at that age, I mean, the good news is you don't have a family, you don't have crazy expenses. It's the time to do it. It's going to be a lot easier to do it at that age than it will be in your 30s. But my main piece of advice will be, don't be scared to fail. Don't be scared to pivot.
David?
When it comes to thinking of what to do, I think that's where a lot of people fail. You have most people are followers. Now every company wants to hire a leader. Every group says that they bring in leaders or they make leaders, but that's not true. even at the highest levels of power, and in politics, where you have all these people, they don't come up with their own ideas. They follow what other people have already been doing, and they keep doing that, even if it fails, because they're followers. So if you want to think of something new that others aren't doing, that's where a lot of people are going to fail, I think. So for that, try to look at areas where a lot of people are doing things manually, doing things slowly, doing things on a difficult process, where they don't have information, where they don't know where to get the information, where things can be automated, and you can step in for that, or where things aren't being offered yet. Like maybe they're being offered in some other country, maybe they're being offered in some other city, but they're not being offered in yours yet. And any of those would work for something to start. I think that would be where to begin.
Okay. And for me, I think that, just go out and execute, just do it, just do something, get something out there would be my biggest piece of advice. Because from what I find, even in my own experiences, is that, the longer you stay to do something, the idea of it slowly dies little by little every time you don't do it. It's like, you're rejecting yourself in a sense.
Yeah, that's a good point. I mean, I think put it all together, that's actually really, really incredible advice. I agree with David, being the fault. I mean, like we're all taught to go by the playbook, and that's the thing, right? If you're all taught to go by the playbook, and you do want to follow the playbook to a certain degree, but you have to learn how to think differently. And that's where I completely agree with David there. And because that's what I've been telling people has been, let's say, my competitive advantage, especially having come from a biology degree, never having taken a course in finance before, doing my CFA exams and like just working my way up. I was never recruited out of school. I did not have the traditional pipeline or the traditional route. So I would say you have to learn how to think differently, and that's one of the things. Like if I look at all the mathematicians and PhDs that I compete against on a daily basis, they've all been trained to think one way.
Yeah.
And I have not been, and that's my greatest advantage is from coming from elsewhere, is that I can think of things in ways that people are just stuck in their one-dimensional way of thinking. And David's right. Don't be one-dimensional. Don't just follow what everybody else says you have to do. You have to learn how to think differently.
Yeah. And I think more or less like, creativity on a whole, just, a last ending point is that, you're mostly creative when you realize that there is no box and that there's just, free game at the end of the day.
I agree.
Yeah. So
yeah, remember, guys, nobody gives you anything in life for free. You have to work for it. Okay. You have to work hard to get what you want. And that's something that I hope, all the entire next generation gets. You don't get what you want for free.
That's true. So I think we'll end off this episode here. This was a great talk on, how to like basically build a business without, venture capital, bootstrapping on a whole. Right. So we'll end off here and see you guys in the next 2 weeks for another episode of the Crypto and Coffee podcast. Likewise, you guys feel free to, listen to us on different platforms like, Spotify, iHeart, Apple Podcasts, all that good stuff. So with that, we'll end off here and see you guys for another episode.
Thank you very much, everyone.
Thank you.